So I'm not exaggerating when I say that learning how to successfully trade the volatility ETFs on the market, like UVXY, SVXY, and all the rest of them, this is quite literally the investing opportunity of a lifetime. If this is your first time seeing a long-term chart of one of these things, this is the UVXY, a 1.5 times leveraged long volatility ETF. Now let me ask you, does this look like it's difficult to gauge the direction that it's going to go in the future? I hope people can see a pattern in this chart. Now obviously managing that risk is the whole game here. That's what my work at VTS is based on. The point is, these products do exist and you simply can't afford to miss this investing opportunity by adding some volatility exposure to your portfolio. So to help you do that, I'm starting a new series here dedicating a separate video to breaking down each one of the main volatility ETPs out there. So give the video a like for me because I'm trying to help you make some money off these things. And now let me give you a visual representation of the current volatility landscape. It all starts with what's called the VIX futures term structure. Now the next video in the series is going to be entirely dedicated to explaining this, because volatility ETPs do not derive their price based on supply and demand of the security itself. It doesn't matter how many people buy the VXX or the UVXY, they actually derive their price entirely based on the values of the VIX futures that they hold at the fund. So to set the table for this series, I'm going to show you exactly what part of the VIX futures term structure each of the volatility ETFs are based on. This is a chart of the VXX, and this was the very first volatility product on the market. It launched live on January 29th, 2009. This is the one that set the whole thing off. It's the original gangster of the volatility space. Now on a split adjusted basis, since inception, it's gone from about 1.6 million down to $15 today. It just decays down, they do a reverse split, it decays more, they split it again, and it loses 99.99% of its value long term. So number one, hopefully you can see now why you need to learn how to trade these things. I wasn't joking when I said it's the opportunity of a lifetime. But number two, the VXX derives its price entirely based on the front 2 months of the VIX futures term structure. Right here, these two VIX futures are everything here. Whatever direction these go, the VXX price goes with them. And as it happens, most of the time they are actually going down. And with a good understanding of the volatility complex, we can actually measure and quantify the times when that is most likely to happen. We can put the odds strongly in our favor. Now that's for future videos in this series. Today I just want to show you where all these land, and the VXX lives right there. It's a front 2 month product with no leverage. It's just 1 times the front 2 month VIX futures. So now let's add all these other ones to the volatility landscape, and then after I can break down individual videos showing you how to make money with each one of them. Now right above the VXX, we're going to put the VIXY. Structurally, this is basically the same thing as the VXX, it's just a different issuing bank, and it is an ETF, an exchange traded fund. The VXX below it, that's an ETN, which means exchange traded note. Now I'll do a video explaining the difference between ETFs and ETNs, but VXX and VIXY price-wise track almost identical. Next, we'll do one of the more popular ones, the UVXY, which is 1.5 times leveraged, and it goes down even more than the VXX. This time on a split adjusted basis from over 500 million down to about $40 today. The 1.5 times leveraged UVXY also uses the exact same front 2 month VIX futures as the other ones. The only difference here is that its daily rebalanced leverage factor is 1.5. The standalone UVXY video will definitely be interesting, so make sure you are subscribed to the channel so you don't miss that when it comes out. But next we've got this diabolical looking ETF called UVIX. This one is a newer launch, but because it's based on VIX futures and an underlying index, we can simulate the prices of that index going back to 2005. Now the UVIX is 2 times leveraged, so the decay is insane here. Split adjusted, are you ready for this? We're talking about 176 trillion down to $12. Yes, trillion with a capital T. That's a lot of decay. But structurally, it is again just using the front 2 months of the VIX futures, just like the other ones. The only difference, it's 2 times leverage, daily rebalanced. Now here we've got a much different looking chart, don't we? This one is called the SVXY, and this is actually opposite of the other ones you've seen. This is an inverse volatility ETF. Essentially, this is directly short volatility. So instead of this one always decaying down like the other ones, this one actually has a skew to go up. Now keep in mind, every time it suffers a massive drawdown because of a volatility spike in the market, that will hinder its progress upwards, so there's nothing smooth about how this thing moves over time. But this is an inverse volatility product. That's why when we put it on the landscape, it goes down here. Highlighted green because this is short volatility. It's the minus 0.5 times half leverage SVXY. Now side note, this SVXY UVXY is actually the product that our flagship tactical volatility strategy is using right now. During stable markets, when the short volatility trade is advantageous, we will be using SVXY. And then, of course, when risk is rising, we move to safety to avoid those big drawdowns, and we can even go long volatility to capitalize on a market crash. But again, understanding how to trade volatility ETFs can be the opportunity of a lifetime. The next one on our list is called SVIX. This is also a short volatility ETF, but this one is the full one-time standard leverage factor. Now, this one is also quite new, but again, we can simulate those prices going back to 2005. Now, for anybody who's been in this space for a while, you might actually remember the old one that was called XIV. That was the first short volatility ETF, and it was launched in November 2010. My old website back then, I was actually writing articles about my trading experiences with XIV going back over 13 years now. But the Volpocalypse event in February 2018 terminated this product. It no longer exists. Now, side note, our strategies didn't lose a single dollar during that crisis, but we did lose the underlying XIV. This new SVIX is structurally quite similar to the old XIV in that it's also a -1 times inverse product, so it goes here. So in total, you can see we've got 6 main volatility ETPs that all play in the front 2-month VIX futures area. Very likely, whenever you hear somebody talking about volatility ETPs, they are probably talking about one of those 6, but there's actually others. This one is called ZIVB. Now, this is again a resurrection, so to speak, of an older product that was around since almost the beginning called ZIV. But you can see this one is a -1 times inverse volatility ETP, but it actually uses different VIX futures in its calculation. We put this one right here out further on the VIX futures curve at the 4th to the 7th month VIX futures. Now, why would this be different? Well, the -1 times SVIX over here and the -1 times ZIVB over here, they're both -1 times leverage, but they're very different performance. Do you notice how the slope of this curve is different on the front end than it is over here from the 4th to the 7th month? It tends to be flatter further out in time, and this essentially means that the ZIVB will move slower in both directions, up and down, compared to the faster moving front month product SVIX. But it is worth noting that it's not very popular. It has a small amount of AUM, so don't be surprised if the ZIVB gets delisted soon. But for now, it's on our landscape over here. Now, what about long volatility? Maybe similar to those other red ones over here, those super fast decaying products. Are there slower moving versions that people could potentially consider instead? The answer is a resounding yes. Again, much like the ZIVB, you can consider these watered down versions, which is great from a risk management perspective. They still drop like a rock, don't worry, but those spikes don't quite rip your face off if you get some bad timing from time to time. Again, within our tactical volatility strategy, you will recognize that VXZ. It's an awesome product for going long volatility just at those strategic times when the market is really crashing. If you look at a comparison just during the financial crisis, for example, you can see a massive discrepancy that traders will definitely want to capitalize on. So we'll throw that one up here as the 1 times midterm VIX futures VXZ. Now, the last vanilla product we'll talk about is the one above there called VIXM. Just like before with the VXX and the VIXY, the only real difference here is again ETF versus ETN. Price-wise, they move the same, they're just wrapped in a different package. The last one we will add to our landscape today is one that I get a ton of questions on, and it's called SVOL. Now, I don't make videos to hack on any products or banks or any of the ETFs that these asset managers have put together. I'm sure they're very proud of what they've created. But if I'm being perfectly honest, the SVOL is probably the most misunderstood volatility product in our entire landscape. We'll put it right there, and you can see I called it Dynamic SVOL. It's also a front 2-month VIX futures product, but the leverage is way down low, and it has an active hedging component, plus it distributes regular dividends as well. So you can see there's multiple layers to this thing. That's why I classify it as dynamic. Spoiler alert, and I'll save this for the standalone video when I talk about SVOL, but this is not nearly as good of a product as people think it is. So as I'm developing this series, the landscape might change. I might throw some extra ones on there, like XVOL, for example, and there's a few others. But this right here, this is enough to get us started. If you take anything away from this video, though, it should be this, that volatility ETPs are in a class by themselves. They derive their value based on a set methodology, and we know those parameters. Quite simply, it's a ridiculously good investing opportunity for those of you who take the time to understand it. As usual, I'm your volatility guy, I'm going to be your guide, and I'm going to go through each one of those in a standalone video and show you the key features so you can make some money. So 2 choices for your next video. Check out this one to see how our main volatility strategy has made over 30% a year since we launched 12 years ago. Or head to the next video where I break down why that VIX futures term structure is so important for our volatility landscape. See you next time.